high-frequency trading. As I mentioned just a few pages ago, most of the Wall Street investment banks, mutual funds, prop firms, and hedge funds base their trading on sophisticated computer algorithms and high-frequency trading. You may have heard about the mysterious black box, the top-secret hidden computer programs, formulas and systems that manipulate the stock market. Some will say that since you can't beat a computer or the high-frequency trading, why even bother trying? To me, this is simply an excuse for not doing well and not working hard enough. I and many other successful day traders have beat the black box, and have profited very nicely in the process. In all honesty, yes, HFT has made trading more difficult and complicated for the individual day trader. It can frustrate you, stress you out. Some of these programs are deliberately designed to go after and beat us day traders. The best way to overcome them is to be very selective in when you make a trade and to monitor the price action very, very closely. Be that guerrilla trader. Find a stock in play. Find the moments when the computer formulas and algorithms cannot take your money. Find your entry point. Make your move. Make your exit. Take your profit. I believe one of the most significant challenges with these black boxes is that the computer programmers who work so many hours each day on the formulas don't have a clue how to day trade themselves. Past market data is very valuable for both you and for their computers. But the stock market is not 100% predictable. It is always changing. There is an uncertainty about it that no computer programmer can fully prepare for in advance. It's impossible for them to upload every single variable. As you observe the market, in real time, you will see those unpredictable moments and you will profit in them. You must be very strategic with every trade you enter. Never forget that in the equally strategic world of chess, Garry Kasparov did win some of his rounds against IBM's Deep Blue. More recently, even IBM's Watson got answer after answer wrong when playing on Jeopardy! You must also remember that any one organization's powerful black box is trading against all of the other organizations' powerful black boxes, and thus they are destined to fail. Not all of them can win. As you practice and gain experience in day trading, you will learn to identify different algorithms and how to trade against them. You can succeed and they can fail. They have actually failed miserably. Of the various HFT programs that are currently operating, one of the least effective is the so-called buy the new low program. When a stock reaches a new intraday low, many day traders will go short to ride the downside momentum. This program then begins to buy the shorts from those day traders to push the price higher. This causes day traders to panic and to cover their shorts. Because the organizations behind HFT programs have almost limitless buying power, the plan sounds flawless. The plan quickly breaks down, however, when another large institutional seller is behind the trade and decides to dump their large positions. This means that regardless of how many shares the program buys, the stock will simply not push higher because institutional sellers and day traders will continue to dump their shares on it. A now classic example of the failure of this sort of HFT took place in September 2008 when the investment bank Lehman Brothers, Federal Home Loan Mortgage Corporation, and many other mortgage holdings and investment banks all suffered a massive drop in price. Programs tried to buy their already broken stock to squeeze and burn the short sellers, but the stock price never went higher. Day traders and huge institutional sellers dumped their shares on the program. The programs and their developers were obliterated and left holding huge quantities of worthless shares of Landfer, as well as other bankrupted holdings. You will read over and over again in this book how important it is to do your homework, to prepare, to practice, to be disciplined, to be smart, to make smart trading moves. You will not win every round against algorithms and HFT, but you can win some of the rounds, and you can profit. You must be able to identify the different algorithmic programs so that you can trade against them. This takes some experience, good mentoring, and practice. HFT programs should be respected but not feared. Always remember that the market is a dynamic and ever-changing place. What works today for traders may not work tomorrow. And because of this, HFT and computerized trading can never completely rule trading. There will always be the need for an intelligent trader who understands the market and price action in real time. And the market is always changing such that it is impossible to program all of the different variables that eliminate the need for trader discretion. There isn't an algorithm that can be programmed to trade against the well-trained and disciplined trader. There are just too many variables in the markets. I always remind my fellow traders who are annoyed by computers that there is really a much larger lesson here. As a day trader, you can complain about anything that takes your money, including of course the annoying algorithmic programs. If you don't do your homework, and are unprepared and uneducated when you start your trading, they will indeed take your money. But you have a choice to either spend your energy complaining or to instead compete with them. I encourage traders to figure out how to use the programs to their advantage. For example, when a program forces short sellers to cover fast, ride the short squeeze on the upside with the program. Find the spots where the algorithms cannot take your money and discover the stocks where you can beat the programs. This is just another reason why you must be in the stocks in play. You won't get anywhere in day trading by complaining about algorithms. What will that accomplish? How will that help you make money? Many retail day traders are consistently making profits by day trading from their home offices. As I have written, new traders have a choice. The market is simply a pattern-solving exercise. Every morning, you need to solve a new puzzle. The algorithms and HFT make it more difficult to decipher these patterns, but they do not make it impossible. Yes, there will always be obstacles and unfair situations in the stock market for retail traders like you and me. We should take small and consistent steps and work harder to profit in the market with its ever-changing situations. But what we should not do, what a trader must never do, is to make excuses. Trade the best, leave the rest. As part of the algorithmic trading by computer systems, the majority of the stocks will trend with the overall market unless they have a reason not to. So, if the market is moving up, the majority of stocks will be moving up. If the overall market is going down, the prices of the majority of stocks will also go down. But, remember, there will be a handful of stocks that will back the trend of the market because they have a catalyst. These are the stocks in play. This is what retail traders are looking for, that small handful of stocks that are going to be running when the markets are tanking, or tanking when the markets are running. If the market is running, and these stocks are running too, that's fine. You just want to ensure you are trading stocks that are moving because they have a fundamental reason to move and are not just moving with the overall market conditions, stocks in play. You may ask, what is the fundamental catalyst for stocks in play that make them suitable for day trading? Stocks in play generally have unexpected fresh news, either positive or negative. Here are some examples. Earnings reports. Earnings warnings, pre-announcements, earnings surprises, FDA approvals, disapprovals, mergers, acquisitions. Alliances, partnerships, major product releases, major contract wins, losses. Restructurings, layoffs, management changes, stock splits, buybacks, debt offerings. When I do reversal trades, my favorite reversal trades are on stocks that are selling off because there has been some bad news regarding that company. If there is a quick sell-off because of bad news, many people will notice and start monitoring the stock for what is called a bottom reversal. If stocks are trending down with the overall market, such as oil was some time ago, you cannot do a good reversal trade. Their value pops up by 10 cents, and you think it's a reversal, but then they are sold off for another 50 cents. They're selling off because they're trending with both the overall market and their sector. Oil was a weak sector for a while in 2014 and 2015, and the majority of the oil and energy stocks were selling off. When a sector is weak, that is not a good time to make a reversal trade. That's where you have to differentiate. So here's the fourth rule of day trading. Rule 4, always ask, is this stock moving because the overall market is moving, or is it moving because it has a unique fundamental catalyst? That's when you have to do a little bit of research. As you become more experienced as a trader, you will be able to differentiate between catalyst-based price action and general market trending. As discussed, as a retail trader, you must be careful that you are not on the wrong side of the trade against institutional traders. But how do you stay out of their way? Instead of trying to find institutional traders, you find out where the retail traders are hanging out on that day and then you trade with them. Think about a schoolyard for a moment. You don't want to be off in the sandbox doing your own thing, trading a stock that no one is paying attention to. You're in the wrong place. Focus where everyone else is focused. Focus on the stock that is moving every single day and receiving literally a ton of action. That is what day traders will be looking at. Can you day trade stocks like Apple or Priceline or Coca-Cola or IBM? Of course you can, but these are slow-moving stocks that are dominated by institutional traders and algorithmic traders, and in general terms they are going to be very hard to day trade. Think of it as the equivalent of hanging out in that isolated sandbox instead of hanging out with your peers in the playground where the cool cats are. How do you determine what retail traders are focused on and your place in that playground? There are a couple of ways to find your best place. One is by watching day trading stock scanners. I explain later in chapters 4 and 7 about how I set up my scanner. The stocks that are gapping significantly up or down are going to be the stocks that retail traders are watching. Secondly, it's good to be in touch with social media and a community of traders. Stock tweets and Twitter are usually good places to learn what is trending. If you follow a handful of traders, then you'll be able to see for yourself what everyone is talking about. There is a huge advantage to being in a community of traders, such as a chatroom, and there are many chatrooms on the internet. As the reader of this book, you are welcome to join our Bear Bull Traders chatroom. We have many traders and we talk about what is hot today. If you're trading completely on your own, you're off in the corner of that proverbial playground. You're not in touch with what other traders are doing, and inevitably you will make it really hard on yourself because you will not know where the activity is. I have tried blocking out social media and trading in a bubble, basically doing my own thing, and it did not work. Draw on the laws of high school survival to guide you. A little more about what I do. As a day trader, I don't trade based on a company's fundamentals such as product, earnings per share growth and financial statements. As I mentioned earlier, I'm not a value investor and I'm not a long-term investor. I don't trade options or futures either, but I do use futures to gain an understanding of the overall market direction in the near-term future. I am an intraday equity trader. I am also a swing trader. In swing trading, I personally do care very much about the fundamentals of the companies I choose to trade, their earnings, dividends, earnings per share, and many other criteria. But swing trading is not the focus of this book, so I won't pursue that topic for now. I'm also a forex trader, and sometimes I trade commodities and currencies. But, in the mornings, I am mostly an equities day trader, and I focus on the real stocks. The majority of day traders don't trade penny stocks or on the over-the-counter market. Penny stocks are extremely manipulated and they do not follow any of the rules and the standard strategies. We trade real stocks. Sometimes we may be trading Facebook and sometimes we may be trading Apple, but we will always be trading the stocks that are having a big day. You may be surprised, but on almost every single day in the market, there's a stock having a big day because the company has released earnings, had a news break, or had something bad or good happen to it. These are the fundamental catalysts that you must look for. What does my day look like as a day trader? You will read about it in detail in Chapter 8, but my trading day typically starts at around 6 a.m. with pre-market scanning. I'm scanning to see where there is volume in the market. As early as 8:30 a.m. New York time, you'll know what stocks are gapping up or gapping down. I then start scouring through the news for catalysts that explain the gaps. I start to put together a watch list. I rule some out and then I pick and choose which ones I do and don't like. By 9:15 a.m. New York time I am in our chat room, going over my watch list with all of our traders. By 9:30 a.m., when the bell rings, my plans are ready. From when the market opens at 9:30 a.m. until around 11:30 a.m. New York time, is when the market will have the most trading volume and also the most volatility. This is the best time to trade and to especially focus on momentum trading. The advantage of having all of that volume is that it provides liquidity. This means there are plenty of buyers and plenty of sellers, which in turn means that you can easily get in and out of trades. Around midday, you can have good trading patterns, but you won't have the volume. This means a lack of liquidity, which makes it harder to get in and out of stocks. This is especially important to consider if you want to take large shares. My focus has always been on trading at the market's opening, which is 9:30 a.m. in New York. I personally trade only within the first 1 or 2 hours of the market's opening. If you joined the chat room that I previously mentioned, you will see that I rarely make any trades after 11:30 a.m. New York time. On a good day I have reached my goal by 7:30 a.m. Vancouver time and I'm easing up. Often by lunchtime I've already hit my goal for the day and I'm going to be sitting on my hands unless there is that perfect setup. From 4 until 6 p.m. I am either in trading courses with our traders or reviewing my trades from the day. I avoid pre-market trading because there is very low liquidity as there are very few traders trading. That means stocks can pop up $1, then drop $1, and you can't get in and out with large shares. You have to go really small, and you have to use such small positions that, for me at least, it's just not worth it. If you don't mind trading in small shares, then you can certainly trade pre-market, but you need to first ensure your broker will allow you to do pre-market trading. I live in Vancouver, Canada, so in my time zone the market opens at 6:30 a.m. Pacific time. This means that my days start really early. The great advantage for me is that I can be finished trading before many of the people in my city are even out of bed. I can then spend the rest of my day skiing, climbing, with family and friends, or focusing on other work and the other businesses that I have. I try to hit my daily goal by 7:30 a.m. my time and then ease up. You know how easy it is to lose money. Once you have some money in your pocket, you should hold on to it. Chapter 3: Risk and Account Management. I've learned, and at times the hard way, that success in day trading comes from initially mastering one proven trading strategy, such as what I have devoted Chapter 7 of this book to: knowing how much to properly enter a trade with and knowing when to properly exit a trade. All without risking any more of your hard-earned money than necessary. And, as has been emphasized several times already in this book, controlling your emotions. It's just like a triangle. You need not have done well in geometry class to know that a triangle needs 3 lines and 3 intersections. Everything is connected. Often, beginner traders who fail to make money in the markets get frustrated and go out and try to learn more about how the markets work, study new strategies, adopt additional technical indicators, follow some different traders, and join other chat rooms. They don't realize that the main cause of their failure is often a lack of self-discipline, the making of impulsive decisions and sloppy risk and money management, not their technical knowledge. You are the only problem you will ever have for your trading career and, of course, you are the only solution to this problem. Each of the strategies outlined in Chapter 7 have been demonstrated, if executed properly, to show positive expectancy. But, before you begin your first trading day, you have to realize and accept in your mind that there will be days when you will lose money. maybe even very badly. It happens to the most experienced of traders, and it will happen to you. Something completely unexpected can happen in the middle of your trade. Please believe me, there is no magic formula for success. One of my favorite trading expressions is live to play another day. This simple saying says so much about the mindset of a professional trader. If you survive the learning curve, then the good times will come and you can become a consistently profitable trader. But you have to survive. And many just can't. A common reason for the failure of new day traders is that they cannot manage their early losses. Accepting profits is easy to do, but it is much more difficult, especially for beginners, to overcome the temptation to wait for losing trades to return to the break-even point. I just give this trade a bit more room, often they say. Waiting for something that is not likely to happen can result in serious damage to their accounts. To be a successful trader, not only you must learn excellent risk management rules, but also you need to firmly implement them. Excellent traders watch their account as careful as scuba divers watch their supply of oxygen. You must have a line in the sand that tells you when to get out of a trade. It's going to be necessary from time to time to admit defeat and say, I was wrong, or the setup isn't ready yet, or I'm getting out of the way. And that acknowledgement must come in a timely fashion. Waiting too long to exit a trade can literally wipe out your entire account. I'm a consistently profitable trader, but I still lose frequently. That means I must have found a way to be a really good loser. Lose gracefully. Take the losses and walk away. If a trade goes against you, exit the trade. In day trading, the unexpected will occur. This is the name of the game. There is always another trade and another day. Holding a position that is trading against you because you are primarily interested in proving your prediction to be correct is bad trading. Your job is not to be correct. Your job is to make money. This career is called trading, not predicting. I can't emphasize enough how important it is to be a good loser. You have to be able to accept a loss. It's an integral part of day trading. In all of the strategies that I explain in Chapter 7, I will let you know what is my entry point, my exit target, as well as my stop loss.